The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The market melt-up is here. Just don't ask too many questions as to why. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Take a look at the Dow Jones Industrial Average. Romaine, we don't cite this very often, but it feels like this is where the action is today.
Yeah, and that's why we had to start this show seated. I didn't know you were going to start with the Dow Jones Industrial
Average.
I know.
I took you by surprise, didn't I? Yeah, it is rare that we quote this, but, you know, it is up about 0.9%. But look at small caps doing even better, 1.8% advance. You were keeping track of how close we were to that record high.
Yeah, absolutely. It's trying to work its way back there, just about, looks like a little less than 40 points away from reclaiming.
We're on watch here for a record close for the Russell 2000. Meantime, small moves in treasuries, the 10-year pretty much stuck around that 4.4% level, and Bitcoin inching ever closer to $100,000.
Absolutely. Here, green on that screen. And if you put up some of the other major averages and indices, green across those screens as well. You take a snapshot of markets right now, and it is a picture of health. 5 straight days now of gains for the S&P. More than 70% of the names above their long-term moving average, is less than 15% in overbought conditions. And with 226 trading days on the books so far this year, the benchmark index has posted records on 51 of those days. Drill down, though, and the picture does get a bit messier as volatility and erratic rotations and re-rotations continue to be a big part of the story. Traders blindsided by the slump back in August and September piled into hedges in October. But a funny thing has happened ever since. CFTC positioning data at the start of November showing the largest collective speculative long positions on nominal S&P futures in 2.5 years, suggesting that investors do see a path for additional market gains.
I mean, there's so much liquidity in the system. And for the Fed to say that the Fed funds rate's restrictive when the stock market's at an all-time record high, Bitcoin is at an all-time record high, real GDP is at an all-time record high. I mean, I'm scratching my head and said, what planet are they on?
Ed Yardeni not alone in that sentiment. David Kelly over at J.P. Morgan Asset Management says strength in corporate earnings and the economy should keep driving the market higher. And a Bloomberg survey released just today shows economists they don't expect a recession until 2027. That's an optimistic revision from just 2 months ago when that same survey in September showed median expectations were for a recession next year.
Yeah, optimism is showing up everywhere. And as the post-election rally lifted the S&P 500 past 6,000, that does kind of give way to questions on whether these gains are in fact sustainable. And one way to express that maybe ambivalence is hedging the index's downside through options. So the S&P 500 in blue, the white line tracking the open interest in put options, bearish bets, relative to bullish call options on SPY, the ETF tracking the S&P. Now, in the past 2 years, when that blue line has moved higher, there's typically been a similar pickup in downside hedging on SPY relative to the upside. But that has not happened in this latest leg, Romaine. You can see that as the S&P 500 has climbed, the put-call ratio has actually been declining.
Yeah, you take a look at those two lines and the divergence. That is, well, an equal sign bullishness, if you will, as we kick you off to the close here on this Friday afternoon. Stocks setting up for another week of gains. And, of course, everyone looking ahead to whether this rally continues, not only through the rest of this year, but into 2025 as well. Scott Chronert is U.S. equity strategist and global head of ETF research over at Citi. And Scott, that is the big parlor game right now. Relatively decent earnings coming out of this earnings season, a relatively strong economy. Why is there any reason to think that market gains can't continue?
Well, I think the only reason to think that it can't continue is one of time frames, and that is pretty simple. We're moving past the period of election uncertainty, which we think manifests in a lot of the hedge fund deleveraging activity that you're referring to in some of the previous charts, but to a period of policy uncertainty. So while we're still in this path where we're seeing nominees for various cabinet-related positions, there's still an aura of uncertainty as to where actual policies are going to take us. So you need to have that frame of reference when we're looking at the current valuation setup, which is 24.5 times trailing, 22 times forward, which is near the highest we've seen in the past 20, if not 30 years. So all told, there's an emphasis on a euphoric backdrop here that is going with a Trump pro-business dynamic at work, but still ahead is going to be the ability and the issue around navigating where some of these specific policy approaches ultimately take us.
With some of those specific policy approaches and the potential negative effects, is that going to be more of an idiosyncratic story? Meaning, is it going to be sort of company by company, or is that potentially going to be a broader market issue?
It's a really good question, and I think that's what we're navigating. Right now, if you look at the sector performance since the election, it tends to align with the general direction of where investors are expecting this policy push to take us. So you've seen financials lead, you've seen energies lead quite notably, you've seen consumer discretionary. On the flip side, you've had areas that are more defensive in nature, healthcare, staples, and to that degree, and even materials, all reflecting some of the broader concerns about where tariffs might take us, where tax policy might take us, and then in the background, how one's thinking about the deregulatory effects that potentially come with this new administration.
Okay, so post-election, it's all been about positioning for what we think a Trump administration will do in terms of policy. But what about the earnings? What has the earnings picture shown us in terms of what people were expecting and what was actually delivered?
Okay, so let's go through this, Scarlett. So you got the Q3 reports now mostly behind us. We got the beat and hold we were looking for. You had a fairly significant beat with Q3 results, okay? But generally speaking, full year 24 estimates didn't change. They're still around 241 as of our latest reading. That's roughly flattish to where we were going into the Q3 reporting period. So Q3 upside led to Q4 downside, flat index earnings for the full year. When you look ahead to 2025, we've still in aggregate are seeing full S&P earnings expectations come down a touch, which is very normal this time of the year. All told, bottom line on this, current consensus next year for up 14% S&P earnings. We're modeling something closer to high single digit, 9 to 10% potentially. We're still leaving some room here for forward expectations to come down. This is before you factor in some of the policy effects, particularly around tariff potential.
Absolutely. So where does that leave us in terms of who's doing the heavy lifting? Which sectors are doing the heavy lifting when it comes to earnings prospects? I mean, do we come back once again to the Mag 7 names?
Yeah, so this is where it gets really interesting. So the Mag 7, you break it down, NVIDIA is still projecting somewhere around 40% plus earnings growth for next year. I'd say in the heels of their quarter, that's pretty visible. The rest of the Mag 7, we're talking up 20%, and you get a noticeable upward bump with Q3 results. The other 493 still tapering lower here, right? So the way we're talking about it is that we want to be exposed via growth and cyclicals barbell. But what's happening here is that Mag 7 cohort is becoming sort of your stable arena, right? When you're looking for areas of uncertainty elsewhere in the market around policy implications, you come back to the visibility you get with the Mag 7, and that sort of comforting, if you will, has us in a position where we want to be continued holders of these names. But we're still thinking that the ultimate opportunity here is going to be a broadening thing as we push down an improving earnings growth picture for the bulk of 2025.
I am curious, though. I mean, what actually does diversification look like in this environment, in these scenarios here? Because we talk about the gains we saw this year, particularly at the start of the year through the first 6 months, and the concentration in big tech. And I know we've gotten some modicum of broadening, but as you know, Scott, there are still a lot of people kind of looking this gift horse in the mouth and saying this can't be real.
Right. So, we look at it through a sort of a sector lens, and the easiest way to express this is how we see sectors setting up, right? And as an example, we've been overweight, the combination of financials, energy, consumer discretionary, and even communication services going into Q4. So we're more or less aligned with where we think some of the Trump policy platforms taking us. But where I want to shift the discussion, you mentioned it earlier, you look at U.S. small mid-cap as an example, and this is a part of the market that on a year-to-date basis has lagged the S&P, but you look back over trailing 12 months, it's actually performing right in line with the S&P. It's a great broadening play. It generally aligns with where Trump policy platform is taking us. You have a much easier starting point, and then if we're correct in the way consensus plays out for next year, you're going to get a narrowing in the earnings growth gap between small mid cap and what we're expecting in large cap.
Yeah, I think a lot of people definitely agree with you, or at least they're hoping for that outcome. Scott, have to leave it there. Have a wonderful weekend. Scott Chronert, U.S. equity strategist and global head of ETF research with Citi, as we kick you off to the close here on this Friday afternoon. A discussion up ahead about artificial intelligence and the startup Anthropic, and a big investment by Amazon. How Amazon is thinking ahead by upping its stake in one of OpenAI's biggest competitors.
Plus, with New York making a U-turn on plans to start charging drivers entering Manhattan a congestion fee, we sit down with the governor of the other state impacted. New Jersey's Phil Murphy tells us why he will try like heck to stop that fee.
All right, and Bloomingdale's already set up for the holiday season, a wicked holiday season, if you will. We're going to talk about the cinematic tie-up that the department store chain has with the big Universal movie that opens this weekend. All that and more coming up in a bit, right here on The Close on Bloomberg.
Welcome back. Amazon is investing an additional $4 billion in the AI startup Anthropic, boosting its stake in one of OpenAI's biggest competitors. And this after a separate $4 billion investment in Anthropic completed earlier this year. So it's proof that Amazon is willing to keep shelling out to get a leg up in the AI arms race. Joining us now to discuss is Mandeep Singh of Bloomberg Intelligence. Mandeep, what does Amazon get in return for this investment, these two rounds of investment?
I mean, not only do they have a large language model that they can natively integrate with, it actually helps re-accelerate their cloud sales, if you think about it, because when it comes to Microsoft, they have said Azure AI workloads would make up $10 billion in incremental revenue to their Azure line. In the case of Amazon, they've said multi-billion dollars, but Amazon Anthropic partnership basically means that Anthropic will be using Amazon chips, and that will actually translate into real AWS revenue. So it makes a ton of sense for Amazon. I think for Anthropic, really, they don't want Amazon to go with open source Meta Llama model, because these models are getting very close when it comes to their reasoning capabilities. So an embrace of open source from Amazon's side would definitely be detrimental for a company like Anthropic that is competing with Gemini and OpenAI. So I think it makes a sense for both of them.
So Google has a relationship with Anthropic as well, and we know the U.S. DOJ is seeking to unwind that deal. So I'm wondering whether regulators, either in the U.S. or elsewhere, might try to obstruct this deal in any way.
Well, so Google, I think, was one of the earliest investors in Anthropic. Amazon came in later. But in the case of Google, they have their own large language model, Llama, and they have made minority investments in Anthropic. And, they offer Anthropic's model on their cloud. But that native integration that Microsoft has with OpenAI, and that's what I think Amazon is trying to do with Anthropic. So Google, from that perspective, should be okay, given it's just a minority investment.
I am curious, though, Mandeep, when we talk about which sort of models, and more importantly, I guess, which sort of business models, if you will, are better. And I know it's still early, and who knows who's going to win this race here. I know you had a chance earlier this year to sit down with the co-founder of Anthropic and talk a little bit about their large language models. Is there a meaningful difference between what I get out of an Anthropic versus an OpenAI versus some of the other competitors out there?
Yeah, so the way these companies train their models, there is a secret sauce when it comes to how OpenAI is doing this versus what Anthropic is doing it. In the case of Meta Llama, they have open sourced the weights of these models. And if you ask these models the same query, they do have a different way of, giving you the answer, especially from a chatbot standpoint. I know Anthropic's strategy is really focused around enterprise customers. They're not trying to compete with ChatGPT or Gemini on the consumer side. And their playbook is, if we keep getting, small enterprise software makers to add more capabilities driven by their large language model, then we are integrated in that ecosystem. So it's all about creating an ecosystem when it comes to foundational large language models. And that's, I think, what Anthropic is seeking here.
All right, Mandeep Singh over at Bloomberg Intelligence, a closer look at Amazon's new investment, $4 billion into Anthropic. That's on top of the $4 billion that is already committed to this prior to that. And of course, Scarlett, everyone's sort of wants to know what sort of the end use case is for all of these large language models. And interesting story today on the Bloomberg terminal about how this will potentially make banks more efficient. Mike Mayo over at Wells Fargo, star analyst there, out with a note saying this is going to boost productivity at banks.
Yeah, which of course is another way of saying maybe we don't need to hire as many bankers to do what they do because they'll be so much more productive with AI. He estimates that banks will increase their tech spend by 10% over the next 2 to 3 years. And as a result, that will help these bankers increase their productivity, maybe do less of the grunt work and get a lot of the number crunching taken care of by machines.
But the caveat, though, is how reliable are these models? And we know, I mean, certainly from the ChatGPT side, we know there's a lot of limitations to what it can do. But even when you talk about these sort of institutional models and how they sort of help the investment bankers or whoever else is going to be using this, how much do you trust it? How much do you rely on it?
I guess everyone's job is now no longer going to be crunching the numbers, but checking the numbers that are crunched by the large language models and everything else.
So the large language models are job creators. All right, coming up here, closing the gap among apparel retailers. That's coming up in our top calls, where we're going to recap the third quarter print from Gap. This is The Close on Bloomberg. All right, time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we're going to start today with PDD. This is the Chinese internet company responsible for e-commerce site Temu, downgraded to neutral over at JP Morgan. The analysts expecting PDD shares to lag behind JD.com and Alibaba in the next 3 to 6 months, making it hard to justify an overweight. He says visibility on short-term financials also is too low and tells investors to maybe revisit the stock if and when the Trump administration implements those tariffs. Depository receipts down for a third straight day here and a seventh straight week back below $100. Next up, let's take a look at the chip design company ARM. After Wells Fargo started fresh coverage of the semiconductor sector, the analyst says a recovery in demand could deliver huge revenue upside for ARM's fiscal 2026 royalty rates, further justifying his overweight rating and 155 price target. Those shares up about 2% on the day. And finally, let's take a look at Deckers Outdoor, getting a buy rating as a new analyst at Needham picks up coverage of sports apparel retailers. The analyst praising Deckers for its consistent beat and raise earnings record, sustained growth from its Hoka and UGG brands, and a fortress balance sheet. He calls Deckers one of the highest quality companies in his coverage. Those shares having a decent day on a 3-day run here to, well, a record high, 192.74. And those are some of our top calls. We do want to stay in the apparel space and take a closer look at shares of Gap, having their best advance since at least May after a relatively stellar third quarter earnings report. Alex Straton joining us right now, Equity Research Executive Director at Morgan Stanley, who's got an overweight on Gap shares. All right, this is setting up potentially, Alex, to be kind of one of those great American turnaround stories. But let's focus specifically on what happened in the most recent quarter and why we're seeing so much enthusiasm. Was this an issue of sales? Was this an issue of costs, inventory? What?
Sure. So it's a great question. I think it's a little bit of everything. But most importantly, I think the headline you should hear is that the third quarter results really provided evidence that new management's brand reinvigoration, or you could call that a turnaround strategy, are proving successful. You saw that in Gap banner momentum, Athleta's impressive inflection to growth, Banana Republic stabilizing. Old Navy was pressured, but you got some encouraging green shoots as weather improved. And then maybe most importantly, operating margin reached its highest level in something like 7 years. So all of those things together paint a pretty compelling picture of this new management team's initial strategy to transform the business and, as a result, transform the financial profile.
So as we get deeper into next year and this management team really sort of gets its sea legs, I am curious, Alex, about what the balance is going to be between all of these units. I think one issue that Gap had in recent years was its almost outsized reliance on Old Navy to drive its growth and its profits, for that matter. I know things are a little bit in flux now with Old Navy, but are we going to see a better balance down the road in the different brands?
Sure. I mean, you're correct in terms of this outsized exposure to Old Navy. I mean, historically, over 50% of the business. And even though it was strong, it was not enough to offset Banana and Gap weakness in the past. I think the good news at this point is that a lot of the repositioning or cost reduction of the Gap and Banana banners has mostly been done. They've rationalized store footprints. They've exited international markets that were not profitable for them. And bigger picture, they've also done a lot of work around inventory, supply chain, average unit costs. So I think over time, Old Navy will still be the big driver of this business. I think its value positioning is important for the business. And Gap and Banana, to some degree, will always be a little bit more fashion sensitive than that one.
Yeah, well, still interesting that Old Navy's comparable sales were unchanged during the period, while I believe Athleta saw the biggest increase of 5% in the quarter. You know, we talk about this turnaround story, and the prime turnaround story that everyone points to in the retail space is Abercrombie & Fitch. Is Gap on its way to becoming an Abercrombie & Fitch type turnaround story? Or if not, what else needs to be done to get it to that level?
Sure. There's definitely some parallels between the Abercrombie story and what the total Gap business is doing at the Gap banner and at the Banana Republic banner. So, for example, at Banana Republic, they're looking to premiumize the positioning, discount less. That's exactly what Abercrombie did. At Gap, they're looking to transform the customer base to be a slightly different demographic. So whereas Abercrombie looked to age up the consumer to a wealthier, more stable consumer that could spend more, support these higher AURs, on the Gap front, it's actually a little bit the exact opposite. They're looking to gain traction with the younger consumer, and they're doing a really nice job of that by partnering with really relevant brands for Gen Z. So there's definitely pieces you can pull from the Abercrombie turnaround, but I do want to just, caveat that with the fact that Old Navy is still the biggest part of this business, and that's not really a turnaround story there.
Okay, fair enough. And that's really interesting that Gap is doing its own way as opposed to going for the more mature customer. We talked about inventory management, how that was worked in Gap's favor this last quarter. How much upside can you keep generating from inventory management? I mean, at some point you reach kind of peak inventory management and there isn't that much more upside, no?
Sure. I mean, inventory, to be clear, across the space is being managed quite well. You see that in the fact that gross margins across the softline space are hitting almost peaks that we've seen in some time, if not ever. So I want to be careful that Gap isn't entirely unique for that advantage. Everyone has made really robust changes and had learnings and made their supply chains more efficient. But for Gap, I think as we move forward from an inventory perspective, there is room for further improvements, whether it's changing your supply chain exposure. You can always be faster. And the best retailers are the fastest from a supply chain perspective. So never say never in terms of the opportunity.
All right, Alex, really appreciate it. Alex Straton over at Morgan Stanley. Thank you so much. All right, coming up, we've got our conversation with the New Jersey Governor, Phil Murphy, about the controversial congestion pricing plan in New York and how his state is managing its budget and how it's responding to that. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And Romaine, we've seen like a slight melt up in markets, although every day the S&P 500 has gained. It's been kind of like a slow, steady drip higher. Yeah, just 0.2% today. But I mean, you add it all up here. We're up more than 1% on the week. And of course, you add it up on a year-to-date basis, and it's shaping up to be a pretty good year. I mean, incremental gains sometimes are good. That's why they call it a melt up. Yeah, absolutely. All right, well, let's talk about New York's polarizing congestion pricing plan, because it is back on, and it's absolutely striking the wrong tone with the neighboring state. Was I not supposed to say that out loud? You're not supposed to say that out loud. It's striking a negative tone with the neighboring state, New Jersey. So for today's Muni Moment, we spoke with the New Jersey Governor, Phil Murphy, on his efforts to fight the fee.
We're going to try like heck. It's not that, listen, I think we've got the strongest environmental record of any state in America over the past 7 years. I'm proud of that. We're not against lowering pollution. We're for that. But there's a time, there's a place, there's a deal that works for New Jersey commuters and ones that don't. And this displaces the pollution to New Jersey. It doesn't get rid of it. It's an enormous burden financially on our commuters. And lastly, none of the money comes back on our side of the Hudson, where we've also got transit fiscal challenges.
Right.
So with all due respect to the MTA, we want them to solve their problem within the four walls of the MTA, just like we have with NJ Transit in New Jersey. And perhaps when the gateway tunnels are finished and you've got 4 tunnels with rail tracks as opposed to 2, or when the Port Authority bus terminal is finished, the new one, which we've got both going at long last, there's a time and a place perhaps, but not now.
Okay, I'm going to follow up on a bunch of those questions. But first of all, when it comes to congestion pricing, you have said that you're open to a form of it. What would that plan need to look like for it to gain your support?
I don't have the parameters of it, but it would need to be a reasonable price, discounts that make sense, an amount of money that comes back to Jersey, and a timetable that allows our commuters to look at what their options are. I think that's a reasonable. By the way, what we've asked the federal judge is we're not asking for the moon. We're asking that he force the federal administration to do an environmental impact study, and we'll live with the results of that.
Have you had conversations specifically with the governor of New York, Kathy Hochul, as well as the mayor of New York about those issues? And if so, what was their response?
So we've got the good news is we start in a very good place with our relationship with both Eric Adams and Kathy Hochul, and we do an enormous amount with both the city and the state together. Yes, we've spoken person to person, team to team, and this has been a multi-year process. And our ask has always been, let's do an environmental impact study, and at the same time, let's get at the table together. And while that's playing itself out, let's talk about what the contours could be of a deal that we could all live with.
But this congestion pricing plan is more than just about the environment. It's obviously to alleviate congestion as well. The idea that there are just a lot of folks coming into this city that, at least certain people think, maybe shouldn't, or they should take public transit into the city. If you don't have the congestion pricing, what is the solution to alleviate the traffic conditions? So
let me say first and foremost, and the MTA wrote this themselves, the number one objective here is to solve their fiscal hole. They've said that themselves. That's it. Don't take my word for it. While congestion and lowering pollution is a noble objective, and it's certainly one of their objectives, it's the number one objective is to solve their fiscal hole. We've got the same challenge at NJ Transit. We've chosen to solve our problems within the 4 walls of New Jersey. We put in a corporate transit fee while New Jersey Transit takes a few years to get back on their fiscal feet, which it will take. All the big transit systems, by the way, in the country are going through a similar reality. We've found a fee, which we don't do lightly, that will allow a bridge to a better fiscal future for them. I don't know what the alternative is for the MTA, but I strongly would like to encourage them to pursue other avenues. As for New York City, we root for New York City. Its success in so many respects is our success. I don't know why, for the life of us, when people are working from home, we're still digging out from a pandemic, why New York City would want fewer people in New York City than more, but that's not my domain.
Let's go back to New Jersey Transit, which you've mentioned a couple of times. Commuters who rely on it, very frustrated by the breakdowns, especially this past summer. You've pledged to fix the system, even if it kills you.
I'm still here. I'm still alive.
You're still alive. You've mentioned this business tax, perhaps, to support NJT. You've also raised fares not so long ago. How much of this is simply a funding problem versus something bigger?
Well, it ultimately will be a big funding problem if we did not find the solutions, and we have found the solutions, which are multi-year. We did not raise fares for 6 years, longest stretch of fares not being raised ever in New Jersey Transit. We just finally raised them this year. We put in place this corporate transit fee. People, I'm not making an excuse for what we're calling the summer of hell. It was unacceptable to commuters. It was unacceptable to me, period. In fact, we put a free week at the end of the summer just as a tip of the cap to the fact that it was a miserable summer. But if you look at the mess we inherited when we first got into office almost 7 years ago, NJ Transit has made a lot of progress on-time performance, safety, customer satisfaction. We don't like anything on those less than 100%, and we will keep fighting until we get there.
Romaine mentioned congestion. Obviously, that's a big goal.
First time I've heard about that.
The Gateway Tunnel project to build those 2 new tunnels under the Hudson River. Donald Trump halted federal funding during his first term. He stalled it, basically. How concerned are you that these funds will be stalled once again or held up or pulled during the second Trump administration?
So first of all, the funds are obligated, and that's a word with heavy definition around federal funding. So that's as close to cement as you get. But having said that, we've found
obligated and dispersed are two different things.
Yeah, but obligated is a big step. Obviously, this is a 8 to 10 year project, so you can't expect that they'll all be dispersed at the moment. Having said that, a big part of the project is the Portal North Bridge, greenlit by Donald Trump as president in June of 2020. I spoke to him last week. That bridge is going to be complete next year, on time and under budget. I asked him if he'd come up and cut the ribbon with me. I don't want to speak for the president, but privately he said he'd very much like to do that. I think he's somebody who understands this region and understands how important infrastructure and moving people and stuff around is. So I'm at this moment with a high degree of confidence. It's a huge union job. Building trades, a job source of tens of thousands. I think the president will be in the right place on this.
And you think you'll have a decent working relationship with them for the next year that you're in office?
I mean, we're gonna fight on stuff as we did. When I walk out of here in January of 26, I will have been the longest serving Democratic governor alongside Donald Trump as president. We've already done it for 3 years. We fought like heck on where our values were challenged, our communities were assaulted or challenged, and will continue to do so. But that does not mean we will not aggressively look for common ground. I have a good relationship with him personally, and we'll continue to do both.
When you first ran for governor 7 or 8 years ago, you ran on a platform of bringing jobs and bringing companies to New Jersey. What has that progress been? And I am curious if you find yourself in competition with your neighboring states, primarily New York and I guess to a smaller extent Connecticut, in attracting those companies and jobs.
Yeah, so our story is a good one, but it's an incomplete one. We've made an enormous amount of progress on GDP growth, on job creation growth. Our unemployment numbers have been coming into a very good spot. We've got a lot of magnets in place that attract both companies and families. #1 public education system in America.
Do new companies want to set up shop in New Jersey?
You bet. The one area where before we got here we had really lost our way as a state was the startup community. And that's now changing dramatically. We've got these strategic innovation hubs in a number of different fields. Venture capital, we were top 3 in the nation in the first half of this year, behind only California and New York. That's the one area in particular where we had a lot of wood to chop and we've made a lot of progress. We're not there yet. We're not satisfied by any means, but a lot of good progress.
Our exclusive conversation with the governor of New Jersey, Phil Murphy, and just before he actually started that conversation, we did learn that the Federal Highway Administration did finally sign off on that congestion pricing plan set to go in effect on January 5th here in New York City. When we come back after the break, a closer look at some of the movers on the day, and that includes Moderna making gains as we head into the close. Why? Well, we're going to discuss some comments out of RFK Jr. That's coming up next in our Stock of the Hour. This is The Close on Bloomberg. Shares of Moderna trying to stage a rebound coming off a 2-week 30% slump that was largely precipitated by fears of what Robert F. Kennedy's nomination to the Department of Health and Human Services could mean for the maker of vaccines. Abigail Doolittle joining us right now for our Stock of the Hour. Moderna, a maker of vaccines. RFK Jr., a skeptic of vaccines. That rattled the stock. But we got a rebound today and yesterday. What's driving that?
Well, we do have an analyst out there from Jefferies saying that he thinks it's peak RFK Jr. negativism around Moderna. I think that this issue is a little bit squishy. It's not clear and dry. I mean, the truth of the matter is RFK Jr. as the Secretary of the Health and Human Services Department is going to have a ton of power. Basically, they rule over the CDC, FDA, NIH, especially in emergency situations. On the other hand, they basically do just the COVID vaccine. They're not in the childhood vaccine. So RFK Jr. is known for being negative against childhood vaccines. And what's really interesting, if we were to take a look at the board of the makers of the childhood vaccines, such as Merck and some of the other ones, they're all down year to date. So now Moderna is down more. Moderna's down about 60% on the year. But if you were to take a look at the numbers for Moderna last
so when you
year,
say childhood vaccines, like what are you talking about? Like mumps?
Yeah,
Well,
they were all. I don't remember the exact ones, but there were a ton of them actually. I mean, I think that some kids before they go to school now get like 30 or 40 vaccines, which is really just kind of an insane amount. But relative to Moderna, I think the real issue is the fact that we're.
I mean, you have a bunch of vaccines, and sometimes you have to get them more than once.
Yeah, and doctors won't let you.
Feeling like 30 or 40 shots, but the actual number of vaccines is not 30 or 40.
And doctors will not allow kids to be in practices if they don't get the vaccines. I mean, it's definitely
public schools, yes,
and doctor practices too, based on my like pediatrician. So I mean, it's definitely a vaccine nation. Although I was speaking to one of our Bloomberg Intelligence or Bloomberg Opinion people.
Nation?
Well, I mean, just an easy way of putting that there, but saying that vaccine uptake overall is actually down. But back to Moderna, last year they put up $6.8 billion in revenue. This year they're expected to do 52% less. So I would say the real problem is coming out of the pandemic has very little to do with RFK Jr. RFK Jr., the impact could be more on the childhood vaccine. Where it could really come in is if his sentiment, if he stays negative or gets more negative, then perhaps that could push on the broader sentiment of really pushing back on vaccines. But right now, I think Moderna's problem is people are not taking that COVID vaccine as much. And that was really, their big, I mean, back in 2021, $18 billion. In 2022, $19 billion. This year, $3.2 billion. That's a fraction. So that really is the story. I mean,
Moderna is all about the COVID vaccine and maybe RSV a little bit, but that's pretty expensive and it's a small part of their business overall. Abigail, thank you as always. Bloomberg's Abigail Doolittle. Coming up, we're going to take you to the closing bells with Adam Turnquist over at LPL Financial. This is The Close on Bloomberg.
That Mag 7 cohort is becoming sort of your stable arena, right? When you're looking for areas of uncertainty elsewhere in the market around policy implications, you come back to the visibility you get with the Mag 7, and that's sort of comforting, if you will, has us in a position where we want to be continued holders of these names, but we're still thinking that the ultimate opportunity here is going to be a broadening thing as we push down an improving earnings growth picture for the bulk of 2025.
Scott Chronert there, kicking us off to the close over at Citi just about 50 minutes ago. The Mag 7 kind of trailing the pack, if you will, definitely on the day and certainly on the week. This has really been all about that rotation into some of the more cyclical pockets of the market.
Which is why I wanted to look at the S&P equal weighted index, right? It's at a record high right now, gaining 0.75% versus 0.25% for the S&P 500. And a lot of that rotation is heading into things like financials, with the KBW Bank Index at a 2.5-year high, and also the industrial companies as well. We're going to see if this continues, but right now it's holding up pretty well. The Bloomberg Dollar Index is now headed for an 8th straight week of gains. It's been an incredible run.
I wonder when this is going to become a bigger part of the story, because when you start talking about economic fundamentals and more importantly corporate earnings here, the dollar is going to play a big factor in that. And there's obviously got to be some balance, particularly with some of the potential policies that might be implemented starting in late January.
Yes. Lots of positioning ahead of that. And, it's not usual that we see a stronger dollar and stronger oil, but there is some geopolitical tensions, Russia, Ukraine, Iran helping to lift oil prices today.
Absolutely here. And of course, still keeping an eye on Bitcoin. We haven't quite gotten to that $100,000 milestone. But of course, when it happens, you'll see all the bells and whistles right here on Bloomberg Television. Adam Turnquist joining us right now, Chief Technical Strategist at LPL Financial, with just about 8 minutes until we get to the closing bells. And Adam, there's been a lot of discussion here about this rally. How much, more room does it have to run? And then everyone just simply looks. They point to this most recent earnings season. They point to the latest set of economic data. And there are a lot of folks out there, a lot of smart folks that really don't see much of an impediment for future gains. How about you?
Look, we got through NVIDIA earnings unscathed here. That was the big event risk this week. And even though they disappointed a little bit on the guidance, here we are Friday coming into the close with an up week for the S&P. And that rotation theme is really driving this. You can see that down cap with the small caps outperforming into the week as investors are rotating maybe a little bit out of we'll call it stretched valuation area of tech and some of those mega cap names into other areas like financials, industrials, And on the small cap side, the regional banks are ripping as well. So that does suggest the bull market is sustainable, albeit a little bit stretched, a little bit overbought, maybe on a short-term basis, but nothing that would suggest a top or anything like that is in play.
I'm curious what you make of this rotation. When you look at the best performing, at least the indices of the week here, you're going to find S&P mid caps up there, gold, oil, a lot of those types of indices. What you're not going to find are the Philadelphia Semiconductor Index or the Mag 7. They've done well this week, but nowhere near enough to be even in the top 15, top 20 of the biggest movers.
No, absolutely not. And I think that surprises a lot of people. When you look at a name like NVIDIA, for example, obviously the poster child of AI, it hasn't made a new high for quite a while, or the SOX Semiconductor Index, for example, I should say, that has not made a new high since July. Meanwhile, the S&Ps continue to make new highs really since breaking out in September. And you can see that relative strength breakdown in the semiconductor space. We view that as a character change of this bull market. When you look at the first 2 years of this bull market, it was all about semiconductors. We've started to see that trend roll over. But the good news for equity investors, financials, industrials, and some of these other cyclical areas are picking up the slack of those semiconductor weakness.
So you don't see too much permanent damage from the fact that the SOX is below its 50, 100, and 200-day moving averages?
Not yet. I think it's really more in a consolidation phase. It is retesting its uptrend off those bear market lows. That's going to be a big test for the bulls going into next week. If we break down from there, you have September lows, the August lows. Maybe if you get to the August lows, that's about a 10% downside from current levels, but not yet to make the call that they've completely rolled over. They've had a massive rally. A lot of times these take time to really consolidate, digest those gains. And I think that's really what we're seeing. And especially when you look at the reaction in NVIDIA that beat revenue, beat on EPS, guided a little bit light. And when I say a little bit light, 400 million above expectations, but the street was looking for, that $1 billion beat. And that's the environment we are in right now, in that high bar for semiconductors. And I think that's going to take a little while to play out and for those expectations to come back to reality a little bit.
Yeah, investors are looking for perfection plus more on top of that. You're the rare technical analyst who also looks at earnings, who also looks at fundamentals. Let me ask you a dumb question. We're waiting for Bitcoin to hit $100,000. Hasn't gotten there yet, probably within $70 at the moment. Can you do technical analysis on Bitcoin? Does that matter to Bitcoin's price action?
Absolutely, and I think that's, from a technician standpoint, the only way to look at it. I think there's a lot of debate on how to value it. I certainly am not going to add any commentary there, or I think it all boils down to technicals and momentum, and that's what we're seeing with Bitcoin rallying, and that gravitational pull to the round number is very present right now as we wait for that $100,000 print.
When you look at some of the moves you've seen in crypto, you combine that with the moves that we've seen in the stock market, Adam, this does feel risk on. We started the show, though, talking about this idea of hedging, or rather the lack thereof, that we've been seeing in this market. And I am curious whether there's any sort of historical parallels where we've seen these types of upward moves in asset prices and these types of downward moves in people buying protection.
There hasn't been a lot of protection buying going on this year. If you look at the VIX, for example, very low vol regime for the first half. We think it's probably going to normalize around its longer term average, 19.5 to 20, as we go into 2025. And that's what we should expect, especially as concentration risk plays out. When you look at, for example, the top 10 names in the S&P weighting 37% of the index, that brings up a lot of concentration risk and a lot of potential for volatility if some of those themes don't play out. But in terms of hedging, we just haven't really seen a lot. It's been risk on, to your point. It's not just Bitcoin rallying, it's the low VIX. We're seeing high beta over low beta, consumer discretionary over consumer staples, and some of these other areas that we look at really to assess risk.
All right, Adam, I'm going to have to leave it there. Adam Turnquist, Chief Technical Strategist at LPL Financial. Counting us down to the closing bells here on this Friday afternoon, just about 2.5 minutes until we get there. And on the week, and you look at those big indexes and what's actually moving the market. It's financials, it's insurance companies, it's oil companies, and of course it's small caps like the Russell 2000, like the S&P 400. That's what's driving this market. Yeah, it's cyclicals, and it's definitely not NVIDIA or semiconductor companies, which is ironic given that this was a big week in which NVIDIA finally announced its results. And, you know, we can kind of wrap up the semiconductor earnings season, the AI story, and because it didn't blow out expectations to the extent that people were expecting, it was a dud. Yeah, the AI story is still intact, though valuations may be giving some people pause. A full breakdown of all the market coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the closing bell, a global simulcast, and it starts right now. We're joined right now in the radio booth by none other than Matt Miller and Emily Grafale. I'm not sure what they did with Carol Massar and Tim Stenevik. Nevertheless, we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, setting up here for a fifth straight day of gains, Matt, on the S&P 500, a weekly gain to boot. But the big story has really been that rotation into some of those cyclical and small cap names.
Yeah, and that's a story I've been hearing about for a few weeks now. I guess the setup is right for a rotation into small caps. And you also didn't really get like a holy camole earnings report from NVIDIA. I guess it was better than a stick in the eye, but it wasn't the typical beat and raise that you saw NVIDIA do the last few quarters. And maybe it took a little wind out of the sail of the mega cap tech stocks, or gave people permission to continue rotating into the Russell.
Yeah, the big tech stocks really dragging today. NASDAQ 100 still probably going to finish in positive territory, but some of those individual names just can't compare today to the small caps, Russell 2000 and the Dow. Yeah, although the Mag 7 did finish the week up about 1.3%. I feel like another big story of the week was Bitcoin. We're all watching for that $100,000 level. We haven't quite gotten there yet. We're just talking with a technical analyst, and he says technical analysis is the only way that you can explain the momentum in Bitcoin prices, because fundamentally the story hasn't really changed all that much. Yeah, absolutely. Here, as we get the closing bells in New York, the clapping, of course, starts. And a lot of reasons to clap. The gains may look modest on the screen on the day, but you add them all up here, and you're looking at a pretty strong week for most of the major indices. The Dow Jones Industrial Average is going to close out the day higher by more than 400 points, or roughly about 1% on the day. The S&P 500 adding about 0.3%, up about 20 points, but still below that 6,000 level where it's going to settle in. The NASDAQ composite adding about 0.2% gain on the day. But the star of the show, again, we have to go back to those small caps. A 1.8% gain on the Russell 2000, a 1.7% gain on the S&P 400 mid caps, and a 1.1% gain on Dow Transports.
Yeah, I mean, I guess a little bit of a barbell situation, if I can use that term, because the Dow, although the kids don't really talk about it anymore, is much bigger cap stocks, right? And the Dow is up 1% as the S&P underperforms, as the NASDAQ underperforms. So it's the Dow and the Russell that are the big winners in terms of the major U.S. averages. Yeah, very well said. Within the S&P 500 today, you have 381 gainers versus 118 decliners. So let's take a look at the IMAP. That big red slice is tech, and that group is down about a fifth of 1%. Utilities and communication services also lower, and so that is why the S&P 500 has not done as well. The gainers are some of those cyclicals that we've been talking about. Industrials up 1.4%. Consumer discretionary gaining 1.2%. Financials up 1.1%. As well. In terms of the gainers, there are a lot of them, but they're relatively small stocks. Again, these are not the big names that you're used to hearing every day, which maybe is a bit of a relief for those of you here sick of hearing about NVIDIA every day. Copart is a company that I think is really interesting. They auction off damaged cars for insurance companies. I think it closed up 10% or more, its biggest gain since March. They reported fiscal first quarter revenue that rose 12% from the year ago period and beat estimates. So people like Copart today, people like Helen of Troy, those shares climbing after they agreed to buy a nail care company called Olive and June. Haven't heard of it, but it's a $240 million deal. Apparently, it includes a $15 million earnout subject to performance over a few years, 2 or I think 3 years. So Helen of Troy shares climbing as well. Moderna is a company that we all heard of, obviously going through the pandemic. mRNA is the ticker there. Those shares up after the company said that RFK Jr.'s nomination to the Department of Health and Human Services is unlikely to mean removal of vaccines. Now, I guess they didn't need to come out and say that for us to believe it. I've heard that from a number of vaccine experts on this program over the past couple of days, but shareholders seem to be at least a little bit supported by those comments from the company directly. And then I threw in one just for my namesake, Matthews International.
That's why you picked it?
The smallest company on the list. I thought it was interesting because they make caskets, memorials, and cremation equipment.
Wow.
That's a demographics play, right? The shares rocketed today. They were up like 20%. 21%. Cremation equipment, I guess, is a hot seller right now. Fourth quarter sales beat Wall Street's expectations.
Okay, well, if you haven't heard of all of the companies that Matt picked for his gainers, you've most likely heard about the companies that were the decliners today. I'm looking at NVIDIA. It's actually about flat on the week, but it did close lower, over 3% today. This, of course, after it's already up 186% year to date. Speaking after the release of quarterly results, Chief Executive Officer Jensen Huang said that NVIDIA's highly anticipated Blackwell products will ship this quarter amid very strong demand, but the production and engineering costs of the chips will weigh on profit margins. I'm also looking at Intuit. This is a tax software company. They gave a second quarter forecast for adjusted earnings that came in weaker than expected. They see EPS $2.55 to $2.61, estimates of $3.23 per share. Barclays said they didn't see much in the results to change the investment story, but they still lowered their price target on this stock to $775 from $800, and that stock closing down almost 6%. And then another mega cap tech stock, Google, the third straight day of declines, closing now at the lowest level since October 24th. The news today coming that Alphabet risks a formal UK investigation over their dominance of web browsers on mobile phones. The UK regulator said in a statement on its interim findings that Google and also Apple can manipulate consumer choices to make their browsers, Safari and Chrome, the clearest or easing option. I picked Google as a decliner because Apple actually finished in the green today.
Good. I'm glad you were able to pivot. Carol would not have been able to juggle that, Emily. You now have her job. All right, let's talk a little yields here. Really interesting story this week in yields. Let's start with the 2-year yield, because for 5 straight weeks now, we have seen that yield go up. Remember, we talk about September, what it was. We were below something like 3.5%. We're now right around that 4.4% level, up about 7 basis points on a weekly basis. But the rest of the curve, it's really sort of a mixed bag. We saw a drop in yields on a weekly basis on both your 10 and 30-year yield, but that's been the seesaw back and forth on a week-to-week basis. A lot of people really are not quite sure exactly what the next step is. But of course, the most sensitive part of the curve to any changes by the Fed is that 2-year, and that is decidedly to the upside, something to keep an eye on here as we close out the week. Matt.
Has everyone seen the Jaguar marketing campaign for their rebranding? Possibly the worst marketing campaign I've ever seen in my entire life.
Yeah,
here
I love it.
We have
where's the car?
Yeah.
There's no car in this video. I guess they're trying to project kind of a new age, maybe a woke kind of message.
This is woke?
This is woke?
Or maybe just tastelessness. I don't know.
This is confusing.
What it is. But they have 17 million followers on Instagram. And last I checked, there were like 35,000 comments, none of them positive about this. Here's the logo. Look at that. The capital G and the capital U in the middle, but nothing else.
Yeah, woke.
I don't know what they're selling.
It's totally woke.
I don't know what they're selling.
I don't know what they're selling. I mean, maybe it's not woke. I don't know what they're trying to say with this.
Maybe it's just a commercial.
I just want to say Don Draper, the fictional Don Draper, is rolling in his grave. If you guys remember that Mad Men episode where he did the Jaguar ad. I don't know why they didn't just pull from Don Draper.
Oh my God, that would have been the best way to do it. I totally agree. The other story that we're keeping an eye on is McDonald's. You know those value meals that have been around since 2018, very popular. They're changing that up, and they're now creating this McValue line as well, which includes a $5 meal deal and a buy one, add one for $1 offer. And this is because the old value meal is no longer feasible because of inflation.
Wait, so they're lowering prices?
No, they're not lowering prices. They're no longer offering the value meal prices, which were low prices. And they're now offering something else called the McValue.
So this is a value
option.
meal, but not the value meal.
Yes, exactly.
Gotcha.
Value 2.0.
Interesting. Okay. You're a McDonald's person, Scarlett,
I
aren't you?
am. I often go.
Yeah.
And
Really?
Yeah.
Yeah,
I
is.
regret it the minute I go, but then, well, that's not true.
I haven't
I'm
been
enjoying
there in
every
20
minute of it
years.
until I'm done with the French fries.
You
Then I regret
didn't
it.
know Scarlett was like a fast food junkie? She just
No.
walks around. She just walks around the office here with a Big Mac.
I
The
have
biggest
done that,
value to
yeah.
me
Yeah.
is going to be not having a heart attack in the next couple of decades because I've avoided McDonald's.
Oh, I don't know.
Emily, are you a McDonald's fan?
Yeah, I like the French fries. I'm staying away from the quarter pounders for a
Yeah.
little bit, but
Fair enough.
maybe I'll go back to that.
Wait, what do you get if you get the quarter pounders? What do they have?
E. coli.
E. coli. Yeah. I guess that was the onions.
I
just
think
the
it's the
onions.
lettuce, right? Or the
onions.
onions? Okay.
Okay. All right.
All right. Well, hey, it's been a pleasure. I know Carol usually has some well-versed statement that she makes at the end of this simulcast, but I don't know what it is. I guess we're thanking our viewers
It's right there
on
on the
YouTube,
teleprompter.
on Bloomberg Originals. Is that still?
Did they not give you a teleprompter
Bloomberg Radio
in there?
and
They don't
Bloomberg
have
Television.
a prompter in there.
Oh.
Only we do.
Thank you. Bye.
There you go.
Bye, guys. Have a great weekend.
All right, stick with us. A lot more coverage coming up here on Bloomberg Television. Beauty and AI, a match made in heaven. We're going to actually sit down with the CEO of Myavana, an AI-driven personalized hair care brand. That's coming up in just a second, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
I'm Romaine Bostic. As we close out the week, the market's closing it out on a high note. Green across the screen for the major indices. The gains on the day may be incremental to be sure, 0.4% on the S&P 500, but relatively strong on a weekly basis, 1.7% for the S&P 500. But your outperformer, once again, was that Russell 2000, adding about 4.4% over the past 5 days, despite the fact that you did see some pressure in the yield space. Yields were down on the 10-year, but they rose for a fifth straight week on the 2-year. Continue to see gold elevated, the dollar elevated, but so too, Scarlett, is Bitcoin right now trading at that 99,000 level. Where will you be when it hits 100,000?
I don't know. I got to get my party hat printed up. So, and confetti and everything. All right, let's take a look at some of the day's biggest movers. We're starting with Super Micro, closing up almost 12%, but for the week, it's up 78%, the best week on record. The server maker hired a new auditor, BDO, to replace EY, which left. And this is all part of the effort to stay listed on the NASDAQ, but the exchange still has to approve the company's plan. So, TBD on that. And Intuit, the worst performer in the S&P 500, down almost 6%, is the maker of the TurboTax tax preparation software, declining after giving a sales and profit outlook for this quarter that missed analyst estimates, even though it has some new AI products, which, maybe should have changed the trajectory a little bit.
Yeah, absolutely. I don't know. AI tax products?
Would you trust AI to do your tax?
No, I barely touch.
I mean,
No.
What kind of explanation would you give the IRS?
No, don't
right?
get me in trouble. Anyway,
AI did it.
Let's get to Factor Friday right now. Chris Cain joining us, as he always does on Fridays, here to talk about how the markets performed on the week. And I know you've been taking a look at the long-short factor, which I think has been kind of a relatively positive trade for most of the year, right?
Yeah, I mean, there's a little bit more than a month left in the year, obviously, and I think it's pretty safe to say that 2024 will be a very strong year for factors. The traditional way you do factor investing, like you mentioned, is long-short, right? So you think about that as a relative trade, right? You're long a group of stocks, short another group of stocks. All three of our four major factors, which is value, momentum, low vol, and quality, are up on the year. Low vol, to a surprise to many, is actually the best long-short factor. Low volatility stocks have done very well, even as the bull market has gone along. Quality and momentum are also up double digits. And again,
Wait, I'm sorry, can I just stop you there?
Sure.
So you're saying, with that trade, you're long, low volatility.
That's right.
And short, high volatility. Hasn't this been a very volatile year, though?
Well, the market overall has been volatile, but the low volatility group has done better, especially when you do a beta neutralize, what's called. So what that means is basically you put more money into low vol stocks, less money into high vol stocks to equalize your betas. So, you're truly market neutral. That factor has done very well. Like I said, momentum and quality. The only one that's down is value, but even that is relatively minor at just about 3%.
If you were just long the S&P 500, you'd be up 25% this year. So what about long-only factors? Which long side factor has done the best this year?
So The long side of the factor that's definitely done the best has been momentum. That's up over 30%. When we say long-only factors, right, we just mean the longest quintile within the Russell 1000. So high momentum, cheap, low vol, and high quality. Now, you said 25% for the S&P 500. You know, the one thing about that is that's a market cap weighted index, and the largest stocks have done the best. If you do look at equal weight Russell 1000, it's only up about 13% or so. 3 of our 4 factors, the long ends, are beating that. Again, the only one that's lagging it is value, but only by about 1%. So the long-only factors have done well. Long-short factors have done well. It's certainly been a strong year for factor investing.
And so when we talk about kind of the trade and how this works with both sides of the trade here, obviously you have to take a look at correlations. And typically you want a negative correlation. So let's take something like momentum and value. What does that correlation look like, and has it changed?
So that is definitely the most watched correlation in quant finance, I would say, especially in equity factors, right? Because they're long-short momentum and long-short value are classically negatively correlated. When you put them together in a portfolio, as you said, it lessens your risk. Now, we had a situation back in 2022 when they were actually positively correlated, which is a bit of a historical anomaly. That has fallen really rapidly. So that's very negatively correlated now. And you can even see that in the performance. Like momentum's up 13% long short this year, value's down 3%, so they are negatively correlated. The other correlation I'll just flag, though, is long short quality versus the market. So when you do a correlation of a long short factor versus the market, you're basically saying, does this group of stocks outperform this other group of stocks as the market goes up or down? So long-short quality has been positively correlated with the market, meaning high-quality stocks outperform when the market goes up. That's opposite of 2 years ago when it was negatively correlated because they were looked at as more of safe havens. Now they're more the bull market favorites.
I think you need another factor in there, and that's political. Just like throw that in there.
Yeah, hard to quantify.
The members will keep changing, but.
Yeah.
What's your thoughts on congestion pricing?
Oh, geez, I don't think you have enough time.
Yeah, okay. All right.
Are you in the area? Do you have to take a? Oh boy, yeah.
So,
Chris Cain has some strong feelings.
There you go. Well, Phil Murphy's on your side.
Okay.
Allegedly.
Chris Cain of Bloomberg Intelligence, a resident of Hoboken, so he's got some thoughts on congestion pricing. You have thoughts on congestion pricing?
I mean, you know.
You're a Manhattan boy, so you're fine, right?
I'm in Manhattan, and I don't drive, so I couldn't care less, to be honest with you.
So you're just like, oh, interesting. People are arguing about this.
I'm a place of privilege, so, I embrace it.
All right, coming up, we've got the top 3, where we focus on the top 3 movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. All right, it is time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Daniel Jones. He is the New York Giants football quarterback, and he is leaving the team. He had signed a 4-year, $160 million extension with the Giants last year, lost out on the QB1 role earlier this week, and then asked to be released.
Yeah, calling him a quarterback, that's kind of generous, but kind of interesting too. What's going on with your New York teams? Your New York teams.
My New York teams?
And their quarterbacks.
Yeah, it hasn't been good year.
Yeah, I mean, Aaron Rodgers hasn't quite done anything.
No.
That
You know what? Both teams are in rebuilding mode. I'll be generous.
It's been a long rebuilding mode for both of them. You know how I'm keeping an eye on? Let's talk about something happier. Lindsay Lohan. Remember her?
Yes, of
She's
course.
just a joy. And do you remember The Parent Trap?
Yeah, her best movie.
Where she basically played
her
best movie. Thank you, Scarlett. So remember, she basically played herself, a twin. She actually said that she actually told, at the time, the CEO of Disney that she should be paid, Michael Eisner at the time, that she should have gotten 2 paychecks for playing the twin, and I am on her side. Two different roles, 2 different characters. That should be 2 different paychecks.
I totally agree. And the amazing part is that she made this comment when she was 12 years old. So, the gumption,
smart girl.
Right?
Yeah.
Apparently that was the first and only time she actually auditioned for a movie role as well.
Yeah, and good for her. I don't know if you've been keeping an eye on her, but she's really glowed up over the last couple of years.
Nice.
Kind of got her life. I mean, everyone tore her down when she was having her issues, but looks like she's living her best life once again.
Well, good for you, Lindsay.
Yeah,
all right, number 3 that we're watching is Mitch McConnell, kind of the opposite of Lindsay Lohan.
Boo.
The longtime Senate Republican leader about to become a Senate wild card when Trump takes office, because he's unlikely to run for re-election, which now means he can speak his own mind because he's no longer responsible for speaking on behalf of all Senate Republicans.
Yeah.
Like when Matt Gaetz withdrew his nomination, Mitch McConnell said it's a good thing.
Yeah, it's interesting. He's definitely been throwing a little bit of shade as of lately, though you kind of wonder, why it took him this long to actually stand up to anything. But this could be intriguing because we talk about this idea of some of the policy initiatives as well as some of the cabinet cabinet appointments, judges. Those are things that they want to get through. And they do kind of need a unified front on the GOP side, assuming that the Democrats vote in the bloc as well. So even losing 1 or 2 votes here and there could have major implications for getting those approvals.
And the new Senate leader, John Thune, is really he's very close with Mitch McConnell. So they kind of form a united front in a way for the Senate Republicans.
Absolutely here. And of course, that has been the parlor game. Everyone keeping an eye on the potential cabinet picks by the Trump administration. Of course, we won't actually get those hearings until January. But once they do, it'll be a big question of whether they can actually get through the confirmation process. Of course, the big prize, the one that everybody is keeping an eye on, is Trump's pick for Treasury Secretary. We've still yet to hear from the president-elect as exactly who he wants, but, well, Kevin Warsh appears to be one of the leaders in that space. Of course, other folks, including Mark Rowan, as well as Scott Chronert, also in the running as well, based on Bloomberg reporting. To talk a little bit more about this is Tobin Marcus. He's the head of U.S. policy and politics over at Wolfe Research. And Tobin, everyone's focus right now on that Treasury pick. It's probably one of the more prominent cabinet positions that we've yet to really hear the president-elect speak about publicly. Based on the names that have been floating out there, there's 3 or 4 that seem to be at the top of that list. What is the likelihood that those 3 or 4 names, that is going to be the winner in that batch?
I think fairly high. Trump world has generally been fairly leak prone over time. So, we've gotten fairly good intelligence as these decision-making processes have played out about who have been the front runners in contention for these various different roles. That doesn't mean that he couldn't, ultimately make a dark horse pick. Matt Gaetz was sort of very firmly reported not to have been on the list that he was presented. So that was one place already this time that he's freelanced. When he was making his Fed pick back in 2017 and ended up landing on Powell, there were a lot of ups and downs in the speculation about how he'd go there. But, I think that the reported sort of final 3 or 4 between Rowan, Warsh, Bessent, and maybe Bill Hagerty seem fairly reliable.
Okay, they seem fairly reliable, and it seems like they'll get one of the top economic jobs, if not Treasury Secretary. So which of these folks is most qualified to then be, head of the NEC, for instance, or head of labor?
So, I think I don't want to say that they're totally interchangeable because these are all serious people who have nuanced views, but I think that they have a similar value proposition for Trump. These are all people who've had success in markets, who would bring some credibility facing markets. I think they would be perceived as kind of holding down the more tariff cautious, like somewhat more globalist end of the policy debate within the Trump administration. So, whoever doesn't land at Treasury, if they're interested in it, I think would be a perfectly reasonable person to put it at NEC in particular as sort of another core member of the White House economic team.
I am curious here, too, about the confirmation process. The names that we have on the screen right now for Treasury Secretary, I would think would have a relatively easy time getting confirmed. You mentioned Matt Gaetz, the less said about that, the better. But I think most of us, as soon as we saw that name, said there wasn't a chance in heck that was going to get through the confirmation process. RFK Jr., another controversial pick. Do you think there will be enough pushback, not necessarily from Democrats, but from the Republican Party to actually disrupt that nomination?
I think Gaetz will probably get through. I mean, if I had to circle one of the remaining nominees so far who's at most serious risk of not getting confirmed, I think would be Hegseth at DOD, who somewhat similarly to Gaetz has both a lack of traditional qualifications for the job and some fairly serious allegations about his past conduct. So that's where I think there's a sort of an overlap between, when you look at the defense hawks, folks like McConnell who take DOD very seriously and want someone in that job who they have confidence in, and the people who have concerns about his personal conduct, that there's a kind of a confluence there. But, certainly when we look at RFK, they're not those kinds of personal concerns, really, at least not that haven't already been aired in his sort of very public life to date. And from what I'm hearing from Republicans on the Hill, there's not a lot of coalescing backlash. Apparently, I heard today that the pharmaceutical industry has kind of decided that they're going to launch a more affirmative campaign to try and take him down, but I have not yet seen concrete signs of that.
Okay, so Health and Human Services Secretary nomination would be something that has market impact. There's a lot of concern around government contractors. Booz Allen and Amentum have both seen big declines because of this new Department of Government Efficiency. Although this DOGE office is not meant to be an actual government agency in the way that Homeland Security is. So we're not clear on just how much of a mandate they have, right?
Yeah, no, some of those government services names have gotten absolutely crushed, which has been pretty interesting. Some of that is just a reversal of kind of how well they did in the immediate aftermath of the election. Being seen as Trump winners before they started to be seen as Trump losers. I'm fairly skeptical of exactly how much the Doge is going to be able to accomplish. I mean, as you mentioned, they are sitting outside of government, so they need to kind of reach through the existing government apparatus to force through any changes that they want to make. They put out a big op-ed this week laying out how they're thinking about their plans, and it relies a lot on kind of pushing the limits of what's legal and then inviting litigation, which is an interesting strategy. I'm not sure it's going to work, but they're talking about, mass nullification of regulations with a sort of a gesture at the end of Chevron, and then hoping that's going to hold up in court. Unilaterally canceling spending and hoping that's going to hold up in court. So a lot of interesting litigation there, may or may not work.
All right, Tobin, always appreciate your joining us. Tobin Marcus is head of U.S. policy and politics at Wolfe Research. Romain?
All right, when we return, we're going to take a look back in history and the birth of Pixar Studios and the revolution in computer animated films. Here's a question for you, Scarlett, before we go to break. The best performing Pixar film ever is Inside Out 2, $1.7 billion at the box office worldwide. What was the worst performing Pixar movie of all time?
Oh, that's a good one. I don't know.
All right, time for a look back at this day in history. November 22nd, 1995, Disney, in partnership with Steve Jobs and Pixar, released Toy Story. It was the first major motion picture created completely by computer-generated animation. With a production budget of $30 million, the film would rake in $40 million in its first 5 days, on its way to a worldwide box office take of $365 million. And while computer animated movies are everywhere these days, what Pixar unveiled on that Wednesday, the day before the U.S. Thanksgiving holiday, would wow the world. Software breakthroughs that made animation feel more lifelike, including plot lines that bridged childhood and adult themes in a way that gave the films much wider appeal. Now, Toy Story would launch Pixar on a 3-decade run of hits, including The Incredibles, Finding Nemo, and Cars, and it would fuel a profit surge at Disney, which leveraged the success of this new type of animation to drive sales of theme park attractions and merchandise, so much so that Disney ended up buying Pixar for $7.4 billion in 2006. Pixar's success, which today includes more than $15 billion in combined box office receipts and 23 Oscar awards, spawned all types of imitators seeking to replicate its technology and storytelling. That includes DreamWorks, responsible for Shrek and Madagascar, as well as Illumination Pictures, which spawned the Despicable Me franchise. Now, things have gotten a bit tough in the computer animation space as of late. 3 Pixar films released straight to streaming during the pandemic, Soul, Luca, and Turning Red, didn't live up to the financial powerhouses of previous years. And Pixar's return to theaters in 2022 with the Toy Story spinoff called Lightyear, it was a bust, the second worst box office performer for the company. And that brings us to the question of the day. What was Pixar's biggest box office flop ever? It was the Tom Holland voiced film called Onward. Now, it wasn't a bad movie, unfortunately, but it did have the misfortune of being released in March of 2020, just days before most of the U.S. entered government-mandated COVID lockdowns. To date, Onward has grossed just about $142 million worldwide. Now, despite the string of relative busts in recent years, Pixar is now trying to reclaim the magic sparked in 1994, balancing original movie ideas with, sequels and spin-offs. The idea that all of its hits from yesteryear can be rebooted in a way that can put Pixar back on a path to infinity and beyond.
Leveraging IP in every way they can, like everyone else. All right, great stuff, Romain. Speaking of movies, Wicked officially opens in theaters today, having already taken in almost $20 million in special advanced screenings. The big screen release is also sparking a retail frenzy, with brands clamoring to partner up. We spoke with Bloomingdale's CEO Olivier Braun about their latest collaboration with the movie.
3, 2, 1!
It's a wicked pairing, a legendary musical.
Of course, Wicked.
And an iconic flagship in the heart of New York City.
It's retail as a theater for us. It's actually bringing experience to the customer, bringing excitement, energy. This is what we're doing. It's not only about selling products, but you're living a moment, which is very important.
Bloomingdale's transforming into the land of Oz, with 150 brands diving into the world of Wicked.
From candles to clothing, the retailer is incorporating the frenzy around the movie into the shopping experience.
Retail overall is very transactional, and I think we have to bring back more about the storytelling from our brand partners to the customer. This is all we're working on right now, and this is a perfect illustration of what we're talking about.
Bloomingdale's is leaning into a more immersive model as questions emerge over the strength of consumer spending this holiday season.
The National Retail Federation expecting sales to grow at a slower pace than last year due to a more discerning consumer.
I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
In year 2 at the helm, CEO Olivier Braun oversees more than 30 stores and 20 outlets, with no plans to expand its international presence. However, the retail veteran is relying on global style and global shopping trends to help revive the U.S. department store experience.
I have a lot of source of inspiration, actually in the U.S., but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world. We want to do less, but bigger, like more impactful, bolder. This is exactly what we're doing.
And no better time to go bold than the holiday season.
We're building memories, and we're building the sales of the future by doing that. So we have to preserve these moments that are very, very special for our customers, for our teams. We love this moment. When you like retail, you love this holiday season. This is the magic happens in the stores.
And that was our conversation with Olivier Braun, the CEO of Bloomingdale's, as the holiday shopping season gets ready to kick off this weekend, Black Friday. So we go from the big screen now to, well, big tech. It's time for our next up segment where we highlight the entrepreneurs and the trendsetters really moving the needle in the markets, in technology, and of course in the venture capital space as well. And the main topic for today is AI and hair care. Joining us here in Studio 2 is Candace Mitchell. She's the founder and CEO of a company called Myavana, which licenses software to help consumers find the best products and routines for their hair. Welcome, Candace.
Thank you so much.
Where in the heck did you get this idea?
Yeah. Actually, in my bathroom, in my dorm at Georgia Tech, my hair was dry, it was breaking off, it was frizzy, and I didn't want to go to class. So I thought to myself, why are these products not working for my hair? And I used my background in computer science to start researching the variables in our hair strands and discovered that your hair is as unique as your fingerprint. That's why it's very specific what type of products will perform the best on your hair. So I wrote an algorithm for it and built a prototype and did my pitch for Myavana.
As overachievers do. And you get to, and now you've got a company and you've got products. Give us an idea of who you're targeting. What's the specific type of customer that you were going after?
Yes, so we are eliminating the trial and error for most product junkies who have tons of product in your bathroom and you're trying to figure out, what product will make my hair shine or retain moisture and things of that nature. So our hair AI tool is for consumers. And we recently launched our hair scopes for professionals, putting the power of AI technology in the hands of stylists to analyze their client's hair and offer a digital healthy hair care plan. Because most people are wondering, again, what actually works for me, and we also want to bring the professionals as the experts to the forefront as well.
So tell us how you make money with this platform. You've got software subscriptions, licensing fees. Who are some of the partners that you've signed up with?
Yes, well, Ulta is one of our biggest retail partners. We license our hair AI technology to offer personalized recommendations to their shoppers in the hair care category. And we power our retailers to do that through our Myavana Pro subscription, where you can instantly innovate and elevate your store experience. We're doing that with our Retail Innovation Academy. And then also for consumers, they can now subscribe to Myavana to start your digital hair profile. So now you don't have to do all of the guesswork or any of the trial and error. Myavana will recommend the best products for you right on your phone, even as you change your hairstyles.
Can I just say too? Yeah. I mean, well, obviously this isn't really for me, but I went through something similar with skincare products. Okay. And you just buy all these things because you want to figure out what works, and you spend a lot of money on stuff.
Trial and error.
That is a lot of trial and error. So I would assume this kind of takes some of that trial and error out of the equation.
Yeah, I mean, everyone's looking for hacks so that they don't have to do all the trial and error. Talk a little bit about consumers' comfort with AI versus professionals' comfort with AI.
Yes, well, we know AI has definitely caused a lot of shakeup in our markets in terms of privacy. But I am on the good side of AI, I like to say, because AI can be used for good. We're using that to deliver this technology to millions of people around the world, and this automated process allows us to deliver that personalized guidance. But my philosophy is that as developers, we have the power to do good or evil, right? So let's use technology for good, and let's also set a standard for the right integrity and ethics to use in our AI practices as well.
Well said. And I'd just like to say, too, that would make a good sequel to Wicked. You know, the good AI, bad
that
AI,
part,
good witch,
that
bad
part.
witch. In all seriousness, though, when you talk about growing this business further here, what are you looking to do? I mean, do you need more people to do that? Do you need more investors? Are you taking outside money right now, or are you just trying to grow organically?
Yes, well, a little bit of both. It's been a long journey. We've grown organically over the years, but just recently closed our seed round, led with Ulta Beauty, their digital innovation fund. But now we're scaling to reach as many customers as possible. So we literally want every person to subscribe to Myavana and start your hair profile. That is the way that we deliver personalized recommendations throughout your hair journey. And so from there, we're also delivering education through cosmetology schools, so we can set a new standard for healthy hair care and also training professionals on how to be really experienced across all textures.
That's really interesting, because you get them while they're in their, where they're still developing their protocol and their expertise.
Exactly.
And you kind of make sure that you're there. Talk a little bit about what kind of what you're doing with the metaverse, because you're making a big play on that as well. And
absolutely,
the metaverse hasn't necessarily turned out the way Mark Zuckerberg wanted it to.
Yeah, I think we're still in the very, very early stages. So it's been one of our special projects because we wanted to create Myavana TV as a new virtual destination for content, commerce, and community. When you go into our virtual hair quarters, we like to call it, we have different rooms for different experiences. In the lab with Myavana, we are re-educating the market on healthy hair care. Then our living room, our community gets together in our virtual hair club, and we have real conversations. Taste of Texture explores our cultural identity through our hair journey talk show, because given where things are today, a lot of people are in distress, with the political climate. Also, a lot of people are suffering with loneliness, different mental health things, and there's really a need for community, in a sense of a place of belonging, if you will. And so I wanted Myavana to be that place, and incorporating, since we are the future of hair care, some virtual reality to really enhance our shopping experiences. And so that's what we're offering to brands, and then doing some advanced training for professionals in our classroom. So it's really like, again, a new virtual world of hair care.
Yeah, and I feel like so many new businesses now, they always have to have some sort of either media component or community component, if you will. The idea is not just about advertising and bringing in customers. You have to make them feel part of the community. This is a really interesting community. It's a really interesting brand, a really interesting idea as well. We wish you the best, and hopefully we can have you back as the company grows.
Absolutely.
And,
I'll be back for sure.
Absolutely. That's Candace Mitchell there. She's the founder and CEO of the AI-driven hair care company, Myavana.
And, we thought AI was going to be a big theme for markets this week, but it turns out NVIDIA, which is the maker of those AI chips that everyone's been all gaga over, didn't really do as much as for the market as we thought it would.
No, and I forgot to ask her. I assume she doesn't have to buy one of those Blackwell chips or something. She could probably do this without that. But those things are expensive.
They are expensive. I mean, there's a ton of demand for it, and they can't make them fast enough. And some of them kind of overheat.
Some are overheating.
Right. That's the other thing.
That's a whole other conversation.
So let's look at how markets closed on the day. You had the Dow Industrials leading the way, and NVIDIA is a member of the Dow now. Don't forget. Up 1% on the day. But really, the story of the week was about the rotation into cyclical segments of the market, right?
And we've seen this before. And remember, the question is, how sustainable is this, right? I mean, we got sort of see the Russell, the small caps sort of bubble back up, and then we get that pullback where everybody just rushes back. But it seems like the majority of the people we speak to on this program seem to be convinced that this is a persistent uptrend for some of those small caps.
Yeah, and of course, a lot of it depends on when we'll actually get more concrete policy proposals out of incoming President Donald Trump. This is a close on Bloomberg. days, being a top athlete requires more than just raw physical talent. There is branding through social media and brand endorsements. And of course, athletes must also learn to navigate the legal world of intellectual property rights. Joining us now is someone who knows that business very well. He is Mike Dockins, better known as the Gimmick Attorney. He counsels his clients, which include members of the WWE, on how to protect their past, present, and future brands. Mike is a partner and a registered patent attorney at the Shumaker Law Firm, and he joins us now. Mike, thank you so much for taking the time. I had no idea there was a market for protecting IP in pro wrestling. How did this idea come about?
It came about by being a fan, honestly. I've been a wrestling fan since I was a kid, and I would read things on the internet and stories about how all these professional wrestlers would retire or leave what company they were with, and they'd have to go by a different name. Not the name that made them famous, not the name that anybody might know, but by their ring name, their stage name. And I thought, boy, they don't know what they don't know. They need somebody to help them. Why not me?
Why not you? So is this basically like name, image, and likeness for public figures in the entertainment world?
It is. It is. Most of these folks that you see here on the screen, some of those, that's their legal name, but most of them, it's not. It's a stage name. It's what they go by. It's their moniker. You have a lot of actors, right? Their legal name is not what they go by, what they're known by. And so for most professional wrestlers, I dare not say all, but for most, it's a stage name.
I'm curious, and forgive me if this is a dumb question, Mike, but what is kind of the interplay that you have with those individual athletes, the individual wrestlers, and the umbrella organization of WWE itself? Do they not control any of the rights to those stage names and likenesses?
Yeah, that's an interesting question. It depends on the company, right? You've got WWE, which is the biggest wrestling company in the entire world, but you have other companies like TNA and AEW and places like that, where their contracts are a little bit different. They're similar, but they're a little bit different. So in WWE, if you come in and you have a name and you're a well-established star, they might let you keep it. And they might let you go by that name that you've gone by, or they might ask you to rebrand. And when you rebrand, or if you rebrand, WWE owns that brand.
Interesting.
For other companies, that's not necessarily the case. You can come in and come up with something and they'll let you own it.
What's the process like when you're working with these wrestlers? Is it easier to create these protections for them when they're just starting out? Or is it easier when they've already kind of, established themselves as, as a presence in their respective organizations, that you then maybe potentially have more leverage to get them those protections?
The process is really similar regardless. There's not too much of a difference one way or the other. When it comes to stage names, it's a trademark. A trademark is a source identifier. Legally, that's what it is. It helps you identify the source of, in this case, services, wrestling services, but in the case of products, it helps you identify the source of the products. So you can start the process based on use. I've been using this in commerce. This is the name I want to use. Check out these pictures or images from these wrestling shows. This is my trademark. Here's the use. Here's the evidence. But you can also do it based on an intent to use. So I intend to use this. I haven't started yet, but I will, and I will prove it when I do. The process is the same either way. Where it becomes important that you're well established is if somebody else has come along and started using the same or similar trademark, because trademark infringement, it's a likelihood of confusion, not necessarily actual confusion, but a likelihood. And so if you have prior use trumps all. So that's where it becomes helpful, is if there's already somewhat of a conflict, something that's in the way, maybe blocking you from owning your own registration. If you came first, there are mechanisms that allow you to get back into the front of the line.
I think of how TKO Group named The Rock to its board of directors, and as part of the agreement that it made with him, he is able to get full ownership of his trademark name, The Rock, along with some of his catchphrases as well. That's kind of the pinnacle of what a lot of your clients are looking to achieve, isn't it?
That's right. That's right. So for Dwayne, when he started in wrestling, while he had a family lineage, right? His father, his grandfather, they were all wrestlers. He did not have a lineage. He was starting from nowhere. $7 Productions. That's what he had in his pocket. He came in as Rocky Myavana, which was an homage to his father, Rocky Johnson, and his grandfather, High Chief Peter Myavana. And so it just became this agglomeration sort of a name and homage to them. And as he progressed, got better known, got more popular, it morphed its way into Dwayne, or into The Rock.
Yeah.
But then when he went back out and went into movies, he didn't necessarily want to trade on that name because he didn't own it. WWE did. So then he started going by Dwayne The Rock Johnson, and then he kind of dropped The Rock, and it was just Dwayne Johnson.
Yeah.
And then, as you referenced, Scarlett, there was a deal in place as part of him joining the board where WWE actually assigned him all of his all of the trademark rights back to him. So now he gets to own them.
I am curious here, and so I should point out I'm old enough to actually remember his father when he was still wrestling here. I also saw in our notes that did you represent Dusty Rhodes at one point?
I did not represent Dusty because Dusty had passed away, but I have done things for his son, Cody Rhodes. And have assisted Dusty's widow in various matters so that they could own that trademark, because Dusty Rhodes, spoiler alert, that's not his real name, his legal name. His legal name was Dusty Virgil Runnels. But most people just know him as Dusty Rhodes. So I did do work with respect to the Dusty Rhodes trademark, but unfortunately not with Dusty himself.
Okay. Yeah, I used to love Dusty Rhodes as a kid. I mean, that whole sort of WCW crew, all those guys out there. I'm not sure who your favorite wrestler is, but those guys, I just love them. I mean, no disrespect to the newer guys. I know it's a whole different era that we live in now, but there was just something special. Dusty Rhodes and Honky Tonk Man and Jimmy Superfly Snukem, Junkyard Dog.
This is like a
Mike, I can keep
lane.
going all day, but I think we're going to have to leave it there. Mike Dockins, thanks for being a good sport here. Partner over at the Shumaker Law Firm. Of course, the gimmick attorney helping, no gimmick at all, helping a lot of these wrestlers protect their name, images, and likenesses.
Can you imagine if we trademarked one of your catchphrases?
Yeah, I'd love it. Maybe
Let's think about what that could be.
Retire a little bit earlier here. All right, we're going to set you up for what to watch over the next week. Stick with us. This is Bloomberg. As we wrap up this week, let's push ahead to some of the potential market-moving events over the next week. And we start off on Monday with the G7 foreign ministers meeting in Italy.
Yeah, there's a lot of geopolitical things that they need to sort out amongst themselves. And of course, we continue with earnings season as well. But, we've entered retail earnings season. There's still a couple of tech companies reporting.
Yeah, Zoom, remember that, the big pandemic darling, and Agilent Technologies as well. Let's move on to Tuesday, though, here, because we get a mixed bag here of economic data and earnings. Let's start with economic data, Scarlett.
Yeah, we've got the house price index and new home sales, so a read on the housing market for sure, and consumer confidence, along with the Richmond Fed manufacturing index and the FOMC minutes.
FOMC, and actually, the FOMC, normally I poo-poo them, but I actually think this one could be actually interesting, too, just to kind of get some thinking here about just how much disagreement there might have been.
Right now, it's 50-50 as to whether the Fed cuts in December.
Particularly heading into that December meeting here. Earnings out of Abercrombie & Fitch, Analog Devices, that's before the bell. After the bell, Dell, CrowdStrike, and Autodesk, and HBQ on Tuesday. Then we move to Wednesday, the PCE price index scheduled to come out that morning.
Yeah, and that'll be one of the main gauges that the Federal Reserve takes a look at to consider whether it wants to actually continue with cutting rates in December. We also get a second read of GDP, and we get pending home sales as well. But, after that morning data comes out, I feel like a lot of the market's just going to say goodbye.
I think a lot of people are going to be gone. Of course, a big holiday in the U.S. with Thanksgiving on Thursday. Of course, financial markets here in the U.S. will be closed, but when we return on Friday, they do reopen, but it's going to be a shortened session.
It'll be a shortened session, half day of trading. France, Italy, and Europe, the Europe area reports inflation, and we open, just make sure that we're open so people can get their trades done.
Do they not celebrate our Thanksgiving?
No, they don't.
Okay.
Definitely not.
Thanks for joining us this week. Scarlett and I will be back for all your markets coverage. For your political coverage, stick around. Balance of Power is up next, right here on Bloomberg.